Welcome to part 2 of the presentation titled The Planning and Details of a Passive Income Portfolio. In this section, this is the second part of 3, I will actually walk you through the actual components of the portfolio. The first portion of my portfolio that I will address is the base and growth components. I'm going to give you about 5 seconds to just get used to the table. 1, 2, 3, 4, 5. I'm going to cover the ETF and the company that provides it. That's column 1. I'll briefly go over the strategy so you get a sense for it. I'll give you a sense for what the participation of these ETFs will be in capital gains. That's kind of relevant, especially once you start talking about covered call ETFs. Next, the fourth column, I'll give you a sense for the expense ratio, assets under management, and liquidity. The reason this is important is, like I mentioned previously, when you have low assets under management, you have poor liquidity, and you're going to have a bit of a spread, sometimes 5 cents, 7 cents, 9 cents between offer and bid, and so it's an inefficient way to trade. In none of these cases does it matter to me because most of my purchases are for the very long term, but it is something that you must be aware of, and it is kind of important. I'll give you a sense for the yield and then the tax efficiency, the kind of accounts that I place these investments in based on how they're treated for tax reporting purposes. So the first 4 ETFs are in green and they are my base. They are the anti-S&P, anti-Nasdaq. They are the absolute opposite of the Nvidias, the Alphabets of the world. So this is my really boring base. So the first one is SCHD. It's provided by Schwab, and it consists of 100 companies with the best composite score of return on equity, free cash flow on debt, 5-year dividend growth, and forward yield. And in my previous presentation, building a nest egg and living off of it, I went into detail on SCHD and explained why these 4 factors are very, very well thought through. For example, you can game the ROE metric by having a lot of debt and low equity, but then you would get caught if you were the company doing so if you didn't have adequate free cash flow to service that debt. So that's just a simple example. So I don't want to get into too much detail because that's not what this particular presentation is about, but I wanted you to understand that this is literally the only pure dividend growth ETF I have. It uses an index called the Dow Jones US Dividend 100. It has a 4% cap on its top holding. So typically the top 10 holdings tend to be about 40%. It has quarterly distributions, is reconstituted annually and rebalanced quarterly. So it's really good. No calls are sold. Therefore, the participation in capital gains is high because you're not giving away any of the gains. It's a very large fund, 40 billion, and a very good expense ratio of 6 basis points. So the liquidity is high, expenses very reasonable to cheap. It typically yields in the range of 3 to 4%. Right now, so I would think about 3.5% as of early June 2024. And all the dividends are qualified dividends. So in my view, they are tax efficient, and I own most of my SCHD in taxable accounts. The next base ETF is Devo from a company called Amplify. It's a small company. What Devo does is it owns 25 companies, equally weighted. So again, low concentration, just like SCHD. It's actively managed, and they select companies with a history of dividend and earnings growth. They sell out of the money calls on about 20% of the portfolio or so. I have monthly distribution. And because the notional, that is the percentage of the portfolio on which calls are sold, are low, the yield is not particularly high, right? So the yield is about 4.5%. In my view, is not particularly tax efficient. 50% of it is categorized as non-destructive return of capital. but I own all my Devo in tax deferred accounts. Participation in capital gains is medium, primarily because a large portion of the portfolio does not have calls sold on it, and the ones that do, the 20% or so, are out of the money call. So there's some participation in capital gains. The expense ratio is high, 55 basis points. It's reasonably liquid. I have not seen a terribly large spread. SCHY is the international version of SCHD, exactly the same selection criteria, the same 10 years of dividend history, same 4 factors for ranking the companies: ROE, free cash flow over debt, 5-year dividend growth, forward yield. The difference is, instead of US companies, SCHD is only US companies, SCHY is only international companies in developed markets, which for me is important because I will not invest in emerging markets and markets with a weak rule of law. This fund the prospectus has a semi-annual distribution, though they have this year done a quarterly distribution in the second quarter. Also, participation capital gains is high for the same reasons as I mentioned for SCHD. Expense ratio of 14 basis points is extremely reasonable for an international fund. It's a relatively small ETF, around $500 million. So the liquidity is medium. I've not personally had any problems or seen a large spread when I have bought it. It's yielding in the range of 4.5% to 5.5%. This morning when I looked at it in early June 2024, it was about 5% annualized if I look at the last year's worth of dividends, and all the dividends are qualified. The last component of my base portfolio is JEPI, JEPI from JP Morgan. Hamilton Reiner, who is the manager, is somebody I respect. And this is important because many investors seem to think that JEPI is a proxy for S&P 500. It's not. First of all, it's actively managed. So that alone tells you a lot. Secondly, it only consists of 100 companies, and they're all within the S&P 500, but they are not the NVIDIAs of the world. It's also got very low concentration. In other words, it does not hold anything more than 2%. And when I looked at the portfolio, I think the largest holdings were 1.6%. So it's very well distributed, value type companies, and they're selected for earnings and cash flow predictability. Kind of the same kind of thinking that SCHD has. They sell out of the money calls. These calls are laddered. I think they're about 2 weeks out at a time, up to 6 weeks out. The calls are sold on the index, on the S&P 500 index, on around 20% of the portfolio. And they have a monthly distribution. The participation in capital gains, I'm going to rank as low because of covered calls. Expense ratio for covered call ETFs is probably the cheapest amongst all the ones that I know of, and I'll show you. It's large and getting larger. It's about 23 billion plus. I think he was explaining they've got $5 billion just in 2024 alone in new AUM. Liquidity is very high. It yields about 7%. 83% of it is non-qualified income. So it's tax inefficient, and all of my JEPI is held in tax deferred accounts. So those 4 are my base. Now let's talk about the growth component, all of which are based on the S&P 500 as the underlying base. QDPL is one of my favorites. It's large enough to own the S&P 500 companies directly. It leaves 88% untouched. So it moves, that 88% moves in tandem with the S&P 500 up and down. It takes 12%. Sometimes I've read it's 13%, but it's in that range, and uses it to purchase futures up to 3 years out. There are papers that indicate that the futures market is more and more inefficient the further out you go, and the advantage accrues to the buyer of the future, which is what QDPL is. They're the buyer of the future. So there's some kind of permanent arbitrage built into it. It's a monthly distribution. Participation capital gains is high. It has performed extraordinarily well from the time I've owned it compared to every other S&P 500 based ETF. Relatively high expense ratio of 79 basis points, not too large, certainly not, I won't call it small, but it's about 200 million plus and getting larger. So I'm going to rate the liquidity as medium. Yields around 6%. The QDPL actually stands for quadruple, where they want to quadruple the yield on the S&P 500, and 6% is approximately quadruple the yield of the S&P 500. Today, I think when I looked at it, it was about 5.5%, something like that. 84% of it is non-destructive return on capital. Non-destructive because the net asset value has either stayed the same or gone up. In the case of my holding, it has gone up 12% or so while yielding the 6%. So I own it in all my accounts, including my taxable account. SPYT is probably the second favorite of mine after QDPL on S&P 500 based covered call future strategies. What they do is they actually own the S&P 500 via IVV, which is iShares S&P 500 ETF. They sell daily call spreads using the S&P 500 index. They cash settle it, which is kind of important, and they give monthly distributions. And call spreads, what call spreads do and why I like the strategy over pure calls is that you get to participate in the gain at above the call that you bought, right? So if the price is 100, you sold a call for 102, you bought a call for 104, so anything above 104 accrues to you, the buyer, in this case, SPYT. So I like the strategy. So I'm going to rate it as medium in terms of capital gains participation, and very high expense ratio, 0.94%, 94 basis points, very small fund, getting larger. So liquidity is low, no two ways about it. The yield I've marked in red at 20% because once you start getting above the 10 to 12%, my antenna goes up. And so far, so good. It has held. There's been no net asset value degradation and the yield has come. So far, so good. 68% non-destructive return of capital. The net asset value has not declined. It's actually gone up a bit. So I feel comfortable holding it in all my accounts. SPYI is from a company called Neos that I respect. They generally consist of people who specialize in options. Many of them have come from PIMCO and so on. What they do is they own all 500 companies directly. They sell out of the money calls 1 to 4% using again the index, which is a positive thing. It's a good thing. Up to 1 month out using laddered call strategy, which is very good. The notional is less than 100. It's typically between 75 to 90%, which is good. They are authorized by the prospectus to buy OTM calls, out of the money calls, if volatility is low. They have never done that, and according to the strategy, they only want to do it when the VIX is below 10. I honestly don't know when that'll ever happen. They cash settle their options, which is good because I don't want them losing the underlying asset. They have a monthly distribution. Participation in capital gains I'm going to rate as low. Expense ratio is certainly better than SPYT. Pretty good size, 1.3 billion, so medium liquidity. A yield that seems extremely reasonable. They aim for 1% a month and a 70% non-destructive return of capital. So I certainly own this in my taxable account too. iSpy is from a rather old school, or at least more experienced provider, ProShares, which has a bunch of very old school type of ETFs. This was their foray into covered calls, and they were actually, I think, the first to do daily, 1 day out of the money option calls. And they do it, they don't actually sell calls, but they do swap agreements, but it's the same thing. They own the underlying assets directly and not through an ETF. They have a monthly distribution. The participation in capital gains I'm going to rate as a little bit higher because of the fact that they're selling daily calls, which is very different from a week out to a month out, right? So I think the statistical odds are better for a daily strategy. Low liquidity, about a 10% yield, 90% non-destructive return of capital. The net asset value has definitely held. It's actually gone up a bit since I bought it. And again, remember, part of my strategy is that if the markets are returning in the 8 to 12% expectation, if I'm getting 10%, 11% in income, I really don't need net asset value improvements to kind of both meet my needs and also not fall too far behind from when compared to the S&P 500. The last one amongst my growth component is XDTE from a relatively new provider called Roundhill. Don't know much about them, but I liked the interviews that the CEO gave and so on. And they do something which I'm studying as to whether it's a positive or a negative, but they own the S&P 500 synthetically. So they have a lot of cash and they generate income from that cash. And what I don't understand is what's the implication of owning the S&P 500 synthetically, which is basically saying buying calls and puts and at the same price and owning it that way versus owning the underlying asset. They again sell 0-day out of the money calls just slightly above whatever the price is, and they have no overnight exposure to the index, which is a very good thing, right? So it's only during the day. And the interesting thing with them is that they have a weekly distribution, which has held. They've done 14, I think, so far. Participation in capital gains is again medium for the same reasons as I gave for iSpy, the daily option. High expense ratio, 95 basis points. They're certainly not leaving any pennies on the table. Very small AUM, but getting larger. Low liquidity, yield of 20%, and 100% so far in non-destructive return of capital. So, I obviously own it in my taxable account too. I'll now address the high growth component of my portfolio. I'll give you 5 seconds to get used to the table. 1, 2, 3, 4, 5. And it's identical to the previous slide. The name and the provider of the ETF, the first column, the strategy is the second column, the participation rate in terms of capital gains for the ETF, third column, expense ratio, assets under management, and therefore liquidity in the fourth column, yield in the fifth column, and tax efficiency. As a reminder, and something I covered in my first presentation, I do want to reiterate that the NASDAQ 100, in my view, is a flawed index in that it only owns companies trading on one exchange, the NASDAQ. And the NASDAQ is only one of 13 exchanges in the US. So it's a very artificial construct, artificial constraint, no different than, saying that I only want to invest in companies whose CEOs wear blue shirts on Mondays. Having said that, it's difficult to argue with the long-term record of the NASDAQ 100, where it has beaten the S&P 500 by about, on average, 200 basis points a year over the long term. So much as I would like to live in a theoretical world where everything makes sense, I have to live in the real world. I have to generate income, and so I have, agreed with myself to own some NASDAQ 100 based instruments. JEPQ, the first one, is one of the older vehicles in the covered call space, or managed by Hamilton Reiner, who also manages JEPI, and is about 8% of my portfolio. And it has, when I bought it, it was yielding around 14%. Now it's yielding around 10 because the price has gone up. And the net asset value since I bought it has gone up about 33%. So clearly these guys know how to both generate income and increase net asset value. Just like JEPI is misunderstood, many people think that JEPI is a substitute or based on the S&P 500. It is not. JEPQ is similar. but JEPQ is more based on the NASDAQ 100 than JEPI ever will be. They own 90 plus companies out of the NASDAQ 100. It's clearly actively managed, and it's a much more concentrated portfolio than JEPI is. So the largest holding in JEPI is under 2%, I think. In JEPQ, the largest holding is in excess of 5%, just like the NASDAQ. And when you look at the top holdings of JEPQ, it does feel like the NASDAQ 100, but it is actively managed. They sell out of the money calls using the index. The vehicle they use is called equity-linked notes, and the counterparty are typically very, very large banks. And so there is a counterparty risk because in case that institution goes bankrupt, there will be nobody to pay JP Morgan to fulfill their end of the bargain, if you will. But two things. One, the counterparties are the largest financial institutions in the world. And secondly, the period of time for these ELNs is typically in the range of 4 to 6 weeks. So it's not something I spend a lot of time worrying about. JEPQ has clearly demonstrated that with their control over notional, that is, they don't sell anywhere near 100% of the portfolio. They don't put 100% of the portfolio in play. And with the active management, they seem to be able to thread the needle between net asset value increases and being able to generate income. I'm rating their participation in capital gains as medium, even though most covered calls strategies, in my view, are typically low. It's highly liquid because it's large and getting larger by the day. The tax efficiency is very inefficient because most of it is non-qualified income. And so I own all of it in my tax deferred accounts. IQQQ from ProShares is the NASDAQ version of iSpy. And it's this exact same strategy. They own the companies directly, the underlying index companies directly. They do the equivalent of daily, one-day option trades via swap agreements. And some of the SPX, they do it on the NDX in this case. They have monthly distributions. Medium participation because of the fact that it's daily and not for a longer period of time. Expense ratio, a little bit on the lower side for covered call ETFs. Not a bad size, 141 million and getting larger, but I'm rating the liquidity as low. The spread can be sometimes 4 or 5 cents. Yields around 10 to 12%. 90% non-destructive return of capital, so I have no problems owning it in my taxable account. QQQI is from NEOS and the NASDAQ version of SPYI. So just like SPYI does, this one owns the underlying index, the NASDAQ 100 companies directly, sells out of the money calls on the index, and the notional is between 75 to 90%. So the entire portfolio is not in play. They use laddering, which is a good thing, and their prospectus allows them to buy covered calls, or rather buy calls, and therefore have a call spread. But the manager was explaining that they only do it when the volatility is very low. And the example he gave was if the VIX was, or the whatever the index for the equivalent of VIX is for the NASDAQ 100 was below 10 or something like that. And I'm not going to hold my breath for that to ever happen. Like most of these, I look for cash settled trades. So these guys do that. They have a monthly distribution. I'm rating their participation in capital gains as low. It's not a very large fund, but it is getting larger by the day. The liquidity is low. Yield is really not bad at about 14%. A little bit on the too high side for me, in that I worry when it starts getting above 12%. It's got a 97% return on capital, and so I'm comfortable owning it in my taxable account. QQQT is the NASDAQ-based version of SPYT, SPYT from Defiance. Same strategy, they own the underlying index companies. Instead of via IVV, they own it via QQQ, sell daily call spreads, and cash settled monthly distributions. The expense ratio is kind of high, 1.05, 105 basis points. It's very, very new, extremely new. And I probably was one of the first 100 investors on it, primarily because of SPYT, uh, aiming for a yield of 20%. If their tax efficiency is like SPYT, it'll be around 60%. And their participation in capital gains is medium um, because of the call spread. QDTE is the NASDAQ version of XDTE, which was on the S&P 500 that I covered in the previous slide, also from Roundhill. Exact same strategy. The one good thing about their daily call strategy is that they have no overnight exposure, which is a positive, and they give weekly distributions. Participation in capital gains medium because of the emphasis on the daily call. Expense ratio on the high side, AUM on the low side, low liquidity, a yield of 30% plus, which I mark in red because I'm not necessarily convinced is a good thing, or I always worry about sustainability. But so far so good. So far so good. I track it every week. The tax efficiency is 100% non-destructive return of capital. The last one is not NASDAQ based. It's called FEPI from a company called Rex. And the underlying index is Solactive something or the other, some technology. It's pure technology, and it's a German-based index, or rather, the index is provided by a German-based company. So the way the index works is they own 15 tech companies, and they're all technology. They're all NVIDIA, Qualcomm, those kind of companies. Equally weighted, 8 companies are fixed, and the next 7 are via market cap. So the reconstitution happens quarterly. So the 7 companies that are based on market cap can get swapped if one of them becomes too small and something else becomes larger. The 8 that are fixed don't change. I consider that to be a flaw, and a relatively large flaw in the design, because I would have wanted it all to be market cap based, kind of like how VGT works. But VGT doesn't generate enough income, and so people like me have to look at FEPI. FEPI is actually held up rather well, and so my position in that has gotten a little bit larger and will eventually end up being 5% if things go the way they are. So what they do is they're selling calls on the individual companies, not on any index, slightly out of the market, laddered, options are rolled, monthly distribution. I like the rebalancing monthly because you're constantly taking gains, but you're selling expensive, buying cheap. So I like that. Participation capital gains I'm going to rate as low. And it's a smallish fund. It's about 230, 250 million. Expense ratio is a little bit on the high side for what they do. They're not a complicated strategy, 65 basis points. I've not found the liquidity to be too poor. So I'm rating it as medium, maybe a 3-4 cent spread, maybe 2 cent spread, something like that. The yield is in the range of 20 to 25%, and it has been consistent. I'll give them that. So I'm holding on to it. Since I bought FEPI several months ago, net asset value has hovered around what I paid for it, and the yield has been at their target yield. So far so good. This is now the last portion of my portfolio, which covers alternatives and then how I deal with cash in my portfolio. So again, I'll give you 5 seconds to get used to the table. 1, 2, 3, 4, 5. So the first portion was my base. The second portion, that was things like SCHD, Devo, so on. Second portion was growth, which were S&P 500 based ETFs like SPYT and QDPL. The third portion was high growth, which were based on the NASDAQ 100, like QQQT and others, FEPI amongst them. Now I come to alternatives. So remember, one of the things is uh, diversification. And this is the reason why I'm spread out, but I'm not diversifying to an extent to where I lower returns, uh, returns both in income from an income perspective or from a total return perspective. So everything that I buy, I try to match it, compare it to how it might perform against the S&P 500. So the reason for the alternative portion is primarily diversification and very different from the rest of the strategy. So the first two are from a company called Simplify. It's a brand that I trust. I don't know how good it is or smart it is to ever trust a financial kind of institution, but I think they do care about the brand. And when I look at the interviews with their senior executives and the fund managers, they seem to exude competence. Um, so let's talk about them both. SWAL is essentially a bet on mean reversion. What they do is they're betting on the VIX. VIX is the 1 month out or so uh, 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 value of volatility in the S&P 500. And if I kept it extremely simple, which is usually the best way to explain things, when volatility spikes up, VIX goes up, and you can go short that new high VIX number. And the reason you can feel comfortable going short most of the time is because it rather rapidly comes back down to whatever the long-term mean number is. And so when you go short, you're basically selling high and buying cheap over and over and over again. And the risk that you have is that it stays high for longer than you would expect it to. And the way to cover the risk and the way these guys do it is by buying a way out of the money call or put as necessary. I think they use calls. So that's how the tail risk is managed. The tail risk is the kind of the exceptional risk that can put you out of business. In my view, the tail risk has not been fully, it's been planned for, and the strategy is very clear and they spend money on it. But I don't know that it's been fully tested because I've not seen um, uh, ridiculously high um, VIX numbers since this product was put into the market. Now the thing, so just like uh, everything out here other than the cash position, everything you see on this page is limited to about 1% of my portfolio. So this is not something where I'm going to be putting in 12, 15% like I put in SCHD or even in the 5 to 7% for QDPL. This is very small positions for diversification purposes. And I'll give you a sense for how each of these has performed since I bought it. So VIX has been yielding 15% since I bought it. That was what they had targeted, and that's what they've been doing. There has been no net asset value degradation. There's been a slight increase. So in other words, I'm getting slightly above S&P 500 returns, and from a different aspect of equity investing, if you will. The participation in capital gains is low because I do not expect this to have a very wide 52-week spread. Expense ratio is seemingly high, but about 66 basis points out of the 116 is interest, and that's more a reporting thing than an actual expense. So the expense ratio I consider for the strategy to be reasonable. 27% of it is non-destructive return of capital in terms of tax efficiency. So I consider this inefficient and I only own it in tax deferred accounts. Maxi simplifies experiment, if you will, with Bitcoin. I have no interest in stores of value. In my risk management framework, that's one of the things I will not invest in: gold, Bitcoin, and so on. But I had recently seen a rather comprehensive interview with Lynn Alden on the Compound, where she explained that Bitcoin has some value that I was not seeing, especially in other countries where their currencies are not strong or trusted. Bitcoin is the way people are keeping their wealth, and they use Bitcoin as the transaction medium for transactions that are cross-border. So I was not aware of that. And then lastly, Bitcoin is capped. It'll not exceed 21 million units. So there'll be a artificial scarcity forever and forever. So what these guys do is they own Bitcoin via a front month Bitcoin future on the CME, and they generate income because the bulk of their assets are in cash. They generate income from the uh, two things: from interest, that's number two, and number one, from short dated option spreads. And what they do is they use various equity and fixed income instruments. It could be broad indexes. They don't actually get into the detail, and they will sell spreads on them. And then they have a strategy for managing the tail risk. Um, Even though I'm saying that it's the tail risk is addressed in the strategy but not fully tested, to some extent they have been tested because they were able to, the ETF moved 160% in 2023 when Bitcoin went from, all the way from the bottom all the way to the top. So they clearly have demonstrated that their strategy in terms of tracking Bitcoin works. The yield is around 6%, and I've excluded a special distribution that they made in December because I never count on special distributions. The special distribution in December, I think, tripled or quadrupled the total income that uh, shareholders in Maxi received. I am making my investment decision on a 6% return, and number one, and number two, because of diversification reasons and because Bitcoin may or may not move with the market, may actually move inversely to the market. Um, all the income is reported as ordinary income, so it's incredibly inefficient from a tax perspective, so I own it only in a tax deferred account. The next um, tranche I would like to cover is from a very new company called Curve. I was impressed by the CEO and his vision and strategy. And what they do is they have individual ETFs that own only one stock, and they own the stock synthetically. They put 100% of the portfolio in play, and they sell out of the money calls, typically 4, 5, 6 weeks out. They're constantly rolled, and they do a monthly distribution. So when I looked at it, and they had 6 companies, so I excluded Tesla, which I think are thought of, and still do, I guess, as vastly overvalued. And I felt very comfortable with Google, Amazon, Netflix, Apple, and Microsoft because I consider them very dominant, very high moats, tremendous throwing off of free cash, and tremendous ability, capabilities in moving on to the next thing, whatever it is. And today, the flavor of the month is AI, and they all seem to be able to leverage it and so on. The participation in capital gains for all of these 5 I've rated as medium. When I looked at the 52-week spread, it was clear that the ETFs can move up. Expense ratios, in my view, are very high at 99 basis points. There's really no reason for that. But I guess they're the only game in town if you want to do this strategy. The AUM is low, but it is increasing. The yield is typically in the 11 to 16% range, depending on which company ETF you're talking about. And the tax efficiency is about 60% non-destructive return of capital. So at its end, if things work out, this will be no more than a 5% position, 1% each in these 5 companies. The next tranche is dividend growth companies. These are 21 companies that remain from my 75 portfolio, 75 company portfolio that existed about 3 to 4 years ago before I moved to ETFs. I've listed them off, starting off with Coke and ending with Texas Instruments. The ones in italicized are the ones I consider lower quality, like Verizon, um, T. Rowe Price amongst them, and Bank of Nova Scotia is the third one. All the others have performed, either very well or extraordinarily well. So the participation in capital gains for all of these companies are obviously extremely high because there's no covered calls on them. There's no issue of AUM, etc., but liquidity is very high. The yield is the lowest of all the tranches at about 3.22%. It's highly tax efficient because all the dividends are qualified. And I aim to be a non-owner, i.e. I will be selling all of these 21 over time, over the next 1 to 5 years, something like that, 2 to 5 years, and move to the covered call ETF strategy. Lastly, when I do have cash in my portfolio, the cash is invested in one of three things. I own all three. SNOX is a money market mutual fund provided by Schwab. So that yields around just under 5%, 4 point something, in the high fours. There's no principal risk because the money market, so you buy it at $1 and you sell it at $1. The other two are not money markets. They are highly liquid. One is SGov, which is 0 to 3 month treasuries sold by iShares. So there's some small fluctuation in principal. It typically moves between $100 per share to $165, $100.65 to $100.05, that kind of a range. So the reason I own some of this is that if I ever want to get immediate access to cash, I can't do that with SNOX because SNOX is the mutual fund and it's only sold at the end of the day. But with SGov, I can get my money immediately and buy something if I wanted to. CSHI is from Neos, another company that I respect, and they're doing exactly the same thing. They own treasuries, but they make some extra money by selling options. And so the range of interest is something like sub 5% for SNOX, just higher than 5% for SGov, and slightly higher than 6% for CSHI. And it's probably like a 70% SNOX, 15% SGov, 15% CSHI, something like that. So it's all treasuries. All three are based on treasuries. So I feel like the underlying assets are very sound. And there's all short duration, right? It's either money market or less than 3 month treasuries. And there's a very limited principal risk because SGov and CSHI do have some very minor fluctuations, less than 50 basis points. Participation capital gains is non-existent, highly liquid, yield is 4.5% plus. It's all income, so highly inefficient. But if it's cash, the cash is where it is. So I own all three of these in all of my accounts, taxable and tax deferred. Let's now discuss the allocation, having understood the ETFs that make up my portfolio. I'm going to chunk them up into 4 groups. Base, which consisted of, if you remember, holdings like SCHD, JEPI, DEVO, SCHY. So they are, in theory, not going to move anywhere in sync with the S&P 500 or the NASDAQ. The growth portion was the portion that was based on the S&P 500 with examples like QDPL, SPYT, iSpy, SPYI, and so on. High growth were the NASDAQ based ones like QQT and JEPQ being examples there. And alternatives were examples of those were SWOL and MAXI, and then the individual company-based ETFs from Curve, the ones that were based on Google and Apple and Microsoft. Base 2 is, the reason I'm separating it from base is, first of all, I'm calling it base because it is anti-growth and high growth in terms of balance. And secondly, it's a separate tranche because it's individual dividend growth companies. So the target allocation is typically, and you can see what I'm shooting for, 35% for base, 35% for growth, 20% for high growth and alternatives, and 10% for the individual dividend growth companies. And in terms of position sizing, I really don't want anything above 15% allocation. SCHD is above that because I had bought a large amount when it had gone down into the 60s, and I've been selling it slowly but surely. But 15% is what I probably feel good about anyone holding. So in base, and JEPI is probably at about 10%. So those are two pretty large, good size holdings in my base. In the growth, I intend to be at 10% or so each minimum on QDPL and SPYT, so I'm building towards that. In high growth, in JEPQ, I'm already at about between 8 to 9%, depends on market valuation. FEPI will be 5%, is heading that way rapidly. QQQT is very new. It'll probably be in the 5 to 7.5% range minimum. And then the individual dividend growth companies, are maximum 1% in any one position. And actually, from a reality point of view, they total approximately 10% of my portfolio today. As a reminder, my benchmark is the S&P 500. And my expectation has three components to it. I expect a slightly lower total return in the range of 100 to 150 basis points on average over the long term. Higher income, and the higher income ensures that I never have to sell assets ever. And lower volatility, which makes it easier to live through pain. So this is the last slide on the second part of 3 in this presentation.